while the Bank of Japan shocked and awed today, in contrast, the Bank of England and the European Central Bank appeared only to whimper, as both central banks opted to leave interest rates on hold. Rich Kelly of TD Securities is on the phone with me now. Rich, let's begin with the Bank of England. The decision to keep the stock of asset purchases in the BoE's quantitative easing programme on hold at £375 billion today may mark a third consecutive defeat for BoE Governor Sir Mervyn King if he kept up his push for a £25 billion increase. Is this an indicator of how on the pulse Sir King remains? Could Mark Carney's BoE takeover in July be the breath of fresh air the UK Central Bank is in need of?
Well, I don't think it's Governor King's job to necessarily have a finger on the pulse. I think it's his job to have a vote like everyone else and to manage that discussion. It shows that he is in the minority in terms of delivering some sort of easing, but I think the broader picture right now within the MPC is that there is a very broad disagreement onto what is really ailing the UK economy, and for each of those ails, what the appropriate tool would be to actually get some sort of transmission. And so I think it's this fragmented nature within the BoE, and the fact that the UK economy is neither good nor terribly bad, but continues to float around zero, that makes the options very difficult. I think Mark Carney is going to face the very same dilemmas when he comes to the BoE in July as Governor King faces right now, but it's just simply a much bigger focus on using verbal communication and perhaps trying to find some other tools to get lending going.
The BoE is under political pressure to do more to stimulate growth after more than 2 years of economic stagnation. If QE is not on the agenda, and as you've mentioned, they need to find alternative tools, what options are open to the central bank?
Well, the BoE's primary focus right now is still to try and get FLS working, to see how that transmission is working into the banks, of effectively providing much cheaper funding into the banks than what they can get relative to the markets, and hopefully see that pass along into lower mortgage and lending rates from the banks that then stimulates more growth and credit in the economy. So we have seen some of that. We've certainly seen the banks look towards that BoE funding rather than market funding. You have seen bank CDS spreads come in, suggesting their wholesale funding costs are down. But while we've seen a lot of survey evidence that suggests that there is a significant amount of easing in credit conditions, I don't think you've seen much in the way of the data showing a lot of that at this point. So mortgage approvals have still been weak, and so I think there's still a question on the transmission there. You also have the focus on the government side, trying to provide some further mortgage incentives to get that going. So for now, the BoE's plan is just to remain very targeted, and so I think you need to see growth much worse before they go to QE. Right now they focus on FLS, and if they see that working and they feel they need more, they may need to find a way to supercharge the FLS, expand it into other sectors, as opposed to returning to a QE style of easing.
Moving over to the European Central Bank, and in a much anticipated move, the ECB also chose to hold interest rates today at 0.75%. As is often the case, all ears were tuned in to ECB President Mario Draghi's press conference. What for you were the key comments here?
Well, I think, the key message here was within the prepared remarks themselves. The ECB downgraded their outlooks for growth. Instead of talking about signs of stabilization, they're now talking about how there may be a gradual recovery, but the data so far is confirming weakness and maybe even weaker than expected. And it's never a strong sign when a central bank talks about downsides to growth but doesn't necessarily offer any prospects for doing anything. That was then where the second half came through in the Q&A, as well as some vague references within the commentary that I think have really turned around markets a bit, but they're now monitoring very closely the information that's coming in, and so that is typically a keyword that suggests within the next few months the ECB is looking at doing something. But the Q&A kind of gave the sense that they still aren't sure what tools would work, and so while there was another wide discussion regarding rate cuts, they seem to be trying themselves to think of some FLS-style program to help credit.
Mr. Draghi did indicate that the ECB stands ready to cut interest rates if the economy deteriorates further. With rates currently at 0.75%, how much further do they really have to go? And similarly, how much worse does the Eurozone need to get for that action to be taken? Can we anticipate a further cut in the coming months?
Well, I think the fact of the matter is, while the refi rate is at 0.75, it's the deposit rate that's sitting at 25 basis points that is really the constraint for them. It's the fact that Ionias have been depressed, and they're really stuck at that bound. So the ECB has to consider whether they want to go into negative rate territory. There is scope for them to cut that refi rate, to narrow the corridors within there, but that refi rate, rather than really giving a direct economic help, would really just reduce some of the funding costs for the outstanding LTROs. So it's still a benefit for some of the weaker banks that still have funds outstanding, but it just doesn't necessarily have the traction that we've had in the past. And so that's really why the ECB has been a bit more hesitant to go down the rate side of things.
Ending on market response to both of these items, both UK and European stocks have wavered, leaning towards a downtrend today on this news. What can we expect from the euro and pound sterling in the wake of today's decisions?
Well, I mean, you look at the euro-dollar reaction, it was really a tale of two halves. So, I mean, we were pessimistic at the start. You saw euro lose a lot of ground, especially helped by what we had from the BOJ overnight. But as we talk through the rest of the press conference, and they seem to be focusing on finding another way to get credit going and seem to be a bit more optimistic on Cyprus, you've had some euro strength, and so that seems to have moved us higher. And I think that's in line with our thoughts that it is much easier, I think, for euro-dollar to move higher than lower, just given how much pessimism is priced in, and given how slowly the ECB seems to want to go down to any sort of rate side decision. For the sterling side of things, again, I mean, there's limited downside and a bit more upside, but I think on that front, really, the BoE is much more in a wait-and-see mode. You're not seeing much come through there. The data over the course of this month is going to probably be poor again, given the weather that we've had. And I think, again, there's not as much scope for sterling to improve off of that.
Rich, thank you for your comments. I'll be back tomorrow to see how all of these events are impacting movements for the euro pairs. But for now, goodbye.